Right. Okay, good evening, guys. Hope all of you are doing well. Okay, welcome to the TRG for this paper, Financial Management. Okay, so we have 4 days together. Okay, I will explain to you what exactly I have planned for these 4 days. And let me just, I'll give the others about 5 minutes since it's the first day. At about 6:10, maybe we will start with what our plan is. Okay, so I don't want to start right now because if someone ends up joining a little later, they will be kind of lost. Okay. With regard to where you can access these recordings, okay, so some of you had asked me if these TRG sessions are available in the form of a recording. So since this is something that we provide to everybody, okay, so not just students of PPIM, TRG is for anybody and everybody, absolutely free. Right. So because of that, we can't obviously upload it in our LMS, which is our learning management system, because only PPIM students have access to that. So for those reasons, this TRG and all other TRGs, they will be available on YouTube. So you just need to find the PPIM YouTube channel. I believe it's PPIM hyphen and ACCA. If you go there, you go under the videos, you should be able to find all the TRGs that we have for this month, and even the previous ones are available. Okay. So recordings, like I said, it's available on YouTube. You can have a look anytime, right? So that's the first thing I just wanted to mention. Okay. Right. So the remainder, I'll just give a few minutes in case somebody wants to join, and then I will start. Okay. Meanwhile, if you're comfortable, you can, kind of introduce yourselves. I don't see any known names. Okay. The moment I said that, one person left.
Yeah.
Yes. Hi.
Hello, Miss. I'm Ahmed. I'm Asjad. I'm from Khalutara. I'm recently joined for the PPIM.
Okay.
I already
Okay. I
discussed
think
with
you saw
Miss
me,
Rosa
right? The other
before.
day. I think you spoke to me.
Yeah.
Right.
Yeah.
Hi, Ashad. Okay. And Amina, I'm not sure if you're a student of PPIM. My student October batch. Okay. I don't remember an Amina. You were online, is it? Or was it like you came for a few classes? Okay, you're online. Okay. Right, so that's good. Right, so let me just, make things clear, right? Came for a few classes. So you were the one who was there, I think, at the very first class, if I'm not mistaken. Was that you? I don't think that person was Amina. I think it's somebody else. Okay. Right. So let's get this straight. Okay. Now, this is the 6th of May. Okay. We are in the 6th of May. We have exactly about 1 month for this financial management paper. Okay. So let me just tell you, I don't know if you guys know me. So let me just introduce myself first. So I'm Aziza. I have 6 Sri Lankan prizes as well as 1 world prize for ACCA papers. Okay. So basically, I'm talking about there are 2 things, right? When it comes to ACCA, there are 2 things. One is learning the subject content. Okay, so learning what is in the paper, that is one part. There is another part, and that is learning how to pass an exam. Both are 2 very different things. Okay, so if you ask me what am I good at, I am good at trying to teach you how to pass this exam well. Okay, I may not be really good at, telling you, okay, this is the subject matter, this is the real life scenario. The reason why I don't go into that detail ever in my classes is because I know that all of you are capable. Now that you have come to this point, I know that you are capable to self-study. Experience will teach you everything. Okay, but experience is not going to teach you how to pass this paper. Okay, so that is why I am here, because nobody is in a position to sit for this exam, fail it and resit again. That is definitely not an option. It used to be an option back in the day, about 6-7 years ago. It was an option because every paper was only 20,000 rupees. Okay, Sri Lankan rupees, it was only 20,000. Why was it so low? Because the UK currency, the British pound, it was depreciating, like how our currency depreciated last year. Their currency was depreciating about 5-6 years ago. Okay, so I'm talking about a time when the exchange rate was 1 Sri Lankan rupee was some 170 pounds. So at that time, yeah, you can definitely try once, try again. It's fine. And, you know, some people are even proud about the fact that they do that. Okay. But now, none of us are in that position. Okay, nobody has the time, nobody has the money. All right. So now at this point, you might be wondering, okay, is this 1 month enough for me? Okay. Now, first thing I will tell you, I have 6 Sri Lankan prizes. I have 1 world prize for advanced financial management, which was a professional level paper. Okay. And I am telling you, even for AFM, I sat for the paper in September. I started learning August 1st. Okay, I also never had the time to like sit for 3-4 months and learn. The maximum I could give for a paper was 1 month, and that is my recommendation also. It will only take you 1 month to properly sit for a paper, and if you do your part well, even a world prize is not something that is not achievable. Okay, so at this point, even if you have done the bare minimum, maybe you just went through your notes, okay? So maybe you just went through 50% of the syllabus, wherever you may be. At this point of time, you have enough and more time to do whatever you need to do before the exam. So what do you have to do, right? So first thing, you have to learn your syllabus. You have to learn your syllabus, right? So take about 5-6 days to do that. You have to understand what's going on, right? The next thing is you have to summarize your syllabus, right? The reason why I keep saying this summary is because maybe towards the end of May, you are doing a paper, okay? You can't remember something. None of us have the time to go back and start looking through the entire study text. That alone will take 1 hour. Right? So that's why whenever you're learning it today, if you're going to sit and learn something, at the end of the day, you know, there will be a time, right, where you can't learn anymore. At that point, summarize whatever you learned for that particular day. That will definitely help you because you will remember what you wrote somewhere. You won't remember what you read in the study text somewhere. Right? So that's the second thing. Third thing is go through your entire revision kit. Go through meaning sit and do it. Okay. And once you're done with the revision kit, again, maybe you do about 6-7 questions in one day. At the end of the day, take a piece of paper and write down what you learned from those questions. Because again, we are not in a position to go back to the question and go through it once again. But we can go back and just look at our mistakes, because if you know what our mistakes are, then the next time you read a similar question, you won't make that kind of a mistake again. Okay, so after all of this is done, make sure that you sit for about 2 mock exams under timed conditions, and that should be it. Okay, but I'm telling you this week, if you come and you ask me, okay, is there enough time? I will say yes, enough time. Even if you want a world prize, there is time. Next week, if you come and ask me, I will tell you there is time, but a prize, I'm not sure. You can get about 70, 80 maybe if you're really good. Okay, if you come the 3rd week of May and you come and ask me, I will say, I think you can scrape a pass. Maybe about 51, 52. If you're lucky, it can even become 48, 49. Unlucky, can't help it. But if you come on the 4th week of May and you ask me, okay, I haven't studied anything still, do I have a chance? I'm telling you, I don't know. I will just ask you, you pray to God and hope that some miracle happens. Okay, because 1 week is not enough for you to learn and, you know, keep it in your head and try more questions. It's just no point. Okay, so that's what I'm telling you. At this point, I'm telling you, you have enough time. So don't misuse this time. Excuse me. Don't misuse this time. Okay, so that's what I'm trying to say. So with regard to these TRGs, how will this help you, right? Now, I am obviously assuming that all of you have gone to some lecture or you know something about financial management. If not, you won't come to a revision class, no? So what I will be doing is in this class, I will focus 100% on questions. Okay, so I will take questions from the revision kit and make sure that I kind of cover all the areas of the syllabus that that particular question is focusing on. Okay, so for example, if one question is focusing on investment appraisal, before we do the question, I will talk a little bit about investment appraisal. Okay, so that is what this TRG will be the next 4 days, right? And I won't just do the big questions. I will do the constructed response, but in addition, I will look at MCQs also. The reason is some people, they fail to understand that whether you can pass a paper or fail a paper is determined by MCQs. Okay, no matter how good you are with the constructed response, you only get 40 marks for that. Okay, that is not the majority. Majority of the marks is coming from MCQs, 60%. So if you're not good at MCQs, MCQs doesn't require you to know too much of that particular area, right? It requires you to think straight. Like you should be able to clearly think what they are asking and figure out what the answer is. So if you don't know how to do an MCQ, I'm telling you, chances of passing this paper is very low for the obvious reason that more weightage is given to MCQs rather than the constructed response. And why do you think they do that? Why do you think for the first 9 papers of ACCA, why are they focusing on MCQs? Reason is when you have MCQs, you can question from all areas of the syllabus. You can start investment appraisal, cost of capital, business finance, risk management, wherever you want, you can question. And you will only give 2 marks, but still the coverage with regard to syllabus is quite a lot when it comes to MCQs. Whereas if you look at constructed response, 120 mark question can only be from one area. If they're asking, it has to be from investment appraisal or cost of finance. It can't go, between 2-3 areas. That won't make sense, right? So that's the reason why we give a lot of weightage to MCQ, because we can question from all areas of the syllabus. Okay, so get your MCQ straight. I'm telling you that it's very important for you to be able to navigate through MCQs. Okay. Okay. Let me see. Okay, right. So let me just start off with a quick introduction in case some of you don't know much about this paper. So this is financial management, the last paper in the skills level. Okay, so it falls over here. Before this paper, we have never spoken about financial management. After this paper, if you want, you can do a paper called Advanced Financial Management if you're interested. If not, you have other options as well. Okay, so what is this paper basically about? Okay, it simply talks about how to manage the finance in a business that you're running. Okay, so for example, if I have extra money, where am I going to put that money? That is investment appraisal. Okay, if I have extra money, where am I going to put it? Where am I going to invest? Am I going to invest in a building? Am I going to invest in a machine, in a new product? How do I make that decision? We have in this particular paper. Then suppose I have a good project that I want to invest in, but I don't have the money. Then how am I going to raise finance? Am I going to go for a bank loan? Am I going to issue shares and get equity? Okay. Or am I going to do something else? How am I going to raise my finance? That's the business finance part. Okay. Then if you are running any business, this is a problem that anybody will have. Okay. Now, most of the time, businesses, we sell on credit. Okay. I mean, in Sri Lanka, yeah, most of the time it's cash based, but that's a different story. In a normal country, usually, if you're a wholesaler, you have to sell on credit to your customer, because the customer, you have to give him time to sell the good, and then only he will give you the money. So usually there will be about 2-3 months gap between the time where the goods are sold and the time when the money reaches you, right? So in this period, the sale is already recorded, because sales revenue, we record it even if it is a credit sale, right? So definitely in the income statement, the profit is there because sales revenue has been recorded. Profit is anyway going to be there. But the issue is the cash hasn't come to hand. Cash hasn't come to hand. Now, that doesn't mean just because the cash hasn't come to hand doesn't mean we don't have expenses. No. For example, if you're running a factory, you will have an electricity bill, you will have a water bill, you will have a telephone bill, you will have to pay salaries. You can't tell your workers, look, see, I have profit in my income statement. After he settles, I will come and pay you your salary. All of them will leave and go. You can't call the electricity board and say, I can't pay this month, I will pay next month or the month after that. That's it. You won't have current in your factory, right? So the issue is you have to have cash for the day-to-day operations of the business. Okay, so dealing with this, the day-to-day operations and the cash that is required, that is the working capital management chapter. Okay, then we move to a very important area when it comes to finance. Okay, and that is when we are dealing with finance, we have to predict a lot of things. Okay, for example, we have to predict our sales. We have to predict our cost. Okay, a lot of things has to be predicted. Now, the issue is, once you make a prediction, after you make a prediction, if what you predicted doesn't happen, that is a very bad thing. Okay, to explain this properly, let's say we predicted in the next year we are going to make a profit. That's a good thing, fine. And we actually made a profit, that's also fine. But say the following year, we predicted to make a profit, but really what happened, we made a loss. So now what happened, we predicted something, something else happened, we are caught off guard. We didn't expect this, now we don't know what to do. Because we predicted something, actually something else happened. That is called risk. Okay, now making a loss or a profit is not risky, because whether if you're running a business, some days will be good, some days will be bad. Some days you will make a profit, other days you will make a loss. That is completely normal. But what is the risky situation? The risk is if there is a loss and you don't predict it, that is a problem. That is a big problem, because if you predicted it, then you can do something, some kind of action can be taken, right? Maybe you can speak to a bank and arrange for a bank loan. Maybe you can ask certain investors if they are willing to put in some cash for some time. So you can do something to help that particular situation. But if you are not able to predict the situation, then only after you go into the problem, you realize that there is a problem. So risk management is that, where there is a variability in the return, a variability in the prediction. So there are two main areas where this is very common for this variation to happen. The first is if you are dealing with foreign exchange. If you're an importer or you're an exporter, obviously you will be dealing with the foreign currencies. So the moment foreign exchange and foreign currency comes into place, the problem is the exchange rate is constantly changing. Okay, so the day you're selling, you might say, okay, I will get 500 million for this sale. But the day the cash actually comes, because of a change in the exchange rate, what you actually get is only 480 million. Okay, so that is a variation. That is a problem. We have to figure out how to manage that situation. The second most important area where you will see this variability is when we talk about interest rates. Okay, so let's say, for example, this is the month of May. I realize in my prediction that in the month of September, there will be a cash shortage. In September, there will be a cash shortage. So what do? I speak to the bank and I say, okay, September, can you arrange for a loan? They will say, okay, sir, according to current interest rate, it's going to be 12%. Okay, but come September, what happens? The bank's interest rate increases. It becomes 15%. Now, the problem is I predicted everything, did my calculations for 12%. But now when I go for the actual loan, what has happened? It has become 15%. So now I have a problem. Okay, so when it comes to these two areas, foreign exchange plus interest rate, you will have this variability problem, which is what we will have to deal with in risk management. Okay, and finally, business valuations. That's basically being able to value a business. Okay, a running business, how do we value it? So the reason why we value it, usually in the case of a sale or a takeover, somebody is coming and, giving you an offer saying, I will give you this much. Are you willing to sell this business to me? In that case, you have to figure out whether the amount is worthwhile or if he is not giving you a good enough price. So for that, you have to do business valuation. Okay. And finally, employability and technology skills. This is not really a big area. It's there in all the skills level papers. It's just where they emphasize the importance of you being able to use a spreadsheet and a word processor. Okay, so the ones that we know of are Excel and Word. So they emphasize you being able to be good at that. The reason is the section C, you have to answer it on a spreadsheet. You have to answer it on a spreadsheet if it is calculation based. You have to answer it on a word processor if it is a theory based question. So you have to be good with formulas. You have to be good with Excel ideally. And you shouldn't, take a lot of time to type. Those kind of mistakes shouldn't happen. Okay, so employability and technology is that. So the reason why we emphasize is because end of the day, all of us want to work in the corporate sector, if that is what we want to do. And in that case, we have to be good with technology. If not, we are going to obviously have a problem. Right? So these are the core areas of your syllabus. The first two, they're just, theory-based areas where they just talk about financial management environment as well as the function. So how financial management works within the organization as well as external to the organization. Okay, so you don't get big questions from these two areas. You'll get small MCQs. You should be able to use your logic and get the answer. Okay. Right. So this is an effective finance manager. So you can see you have the financial objectives, working capital management, business finance, investment appraisal, business valuations, all of that are key decisions that they have to take. And in addition to that, they should be able to manage risk. Risk is usually foreign exchange risk as well as interest rate risk. Okay, so these risks, we actually reduce it. Okay, that's what we do. And whenever you reduce a risk, we give it a name. We call it hedging. So if you have a foreign exchange risk and you want to reduce the risk, we call it foreign exchange hedging. Interest rate risk, you want to reduce it, it's called a interest rate hedging. Okay, so this is basically a glance at your entire syllabus. Okay, this is what we have throughout this paper. Okay. Now, as for the actual exam, these are the steps to success. These are not my steps. This is the examiner steps, right? This you can find in the ACCA website. So steps to success, they're saying, if possible, study with an approved learning partner and with approved learning content. Okay, so if you have attended lectures with any approved learning partner, you have already done this. And approved content, we're talking about either Kaplan or BPP. Okay. Second, study the whole syllabus. Very important. Reason is 60% is MCQs. Okay, so if you just learn 60% of the syllabus and you go, you're definitely not going to be able to pass. Okay, back in the day, there was an option like that also where people only learn 60 to 70%. But the reason why they could do that is because there were certain choices. Like there were about 3 questions, you could choose 2. Okay, so if you don't know working capital management, for example, you can avoid that question. But no more, you can't do that anymore because now that we have a lot of MCQs, you don't have a choice. You have to do 100% of the syllabus. Third, practice exam style and standard questions to time using the ACCA practice platform. Develop your ability to construct effective written response answers. Okay, so that's a section C. Ensure you're competent working in a computer-based exam environment. Those of you who haven't sat for ACCA exams, there's this thing, right? This exam is computer-based. A lot of people complain about the fact that it's very noisy. It actually is. The reason is people are all typing, right? So if this is your first exam, don't go to the paper and get shocked that why is it so noisy? That's how it is. Okay, because everybody is typing on a keyboard. So the sound of keys, you will anyway hear it. Okay, and that's about it. Other than that, you have your calculator. They will give you a little extra sheet if you need. That's about it, right? Nothing much about the computer-based exam. Attempt at least 2 full exams under exam conditions, debrief your answers, then focus on your study on weaker areas. So basically do 2 mock exams. Okay. So tackling the exam, how will the exam paper look like? Okay. So we have 3 sections. Okay. Section A is worth 30 marks. You will have 15 small questions. Okay, so it will be objective task questions, means there will only be a small, maybe 1 or 2 lines, and then there will be 4 options. You have to choose the correct answer. Okay, so short questions worth 2 marks each. So you get 30 marks there itself. Then section B, you have 3 objective task questions, but they are bigger scenario based questions. That means there will be 3 big questions. Each of them will be worth 10 marks. Okay, and there will be a scenario, meaning they will tell you some story. And based on that scenario, they will ask 5 smaller questions. Okay, so 5 small questions, each worth 2 marks. But the entire question will be worth 10 marks, and it will be based on one scenario. Okay, so that is section B. And then we have section C, which is worth 40 marks, where again you will have 2 scenarios. Okay, and each of them will be worth 20 marks each. Okay, so there will be calculations, there will be theory based questions. You should be able to write answers as well. That is basically your section C. Okay. How to do mock exam, ACCA platform, right? So it's like this, Asjad. If you have your, what do you call, the revision kit, then you can obviously go through everything. But if you want one specific paper, like you said, in the ACCA practice platform, you will have it. But what is more important is a few days before the exam. Okay, so that is, let me get you the exact day. ACCA releases a special paper, pre-mock June. I'll tell you exactly when that release happens. Yeah, on the 13th of May, right? So on the 13th of May, ACCA releases a special paper that is catered towards the June exam sitting. So you can see it's released itself on the 13th of May only, right? So that paper, they release it, and after a few days, they haven't told exactly when they will release the exam answers, but they will release answers as well, right? So if you can go through that paper, time yourself and do that paper on the 13th of May, that will definitely help you, because chances are that areas that they might test in the June exam, they might give a small hint in the pre-mock. Okay, so that is one major paper. That's a good option that you can go for. In addition to that, if you want, let me know. I can share a few mock exams with you with the answers as well. So you can time yourself and do them as well. Okay. Right. So that's about it. Okay. So that's about the introduction. I hope you don't have questions here. Okay, because this is just the basics of FM, but I didn't want to miss out in case somebody, you're new to this, right? All right, so now what are we going to do? Let me show you the revision kit. Okay, so you can see here, section A type and section B type questions, they are all MCQs. After that, section C, they have properly divided it into different areas, right? So for example, you have financial management function and environment, working capital, investment appraisal, business finance, business valuations, and risk management, right? So what I'm going to do right now is I will pick one question from investment appraisal and one question from business finance and cost of capital. Okay, so that each question will be worth 20 marks. No? So that will itself take about 45 minutes. Okay. Once we're done with 2 questions, I will go through the specimen paper. Okay, because I don't want to neglect MCQs, right? I told you MCQs is most important. But if I pick MCQs from here, then the problem is I will end up doing only one area for the entire TRG. So what I want to do is I want to cover as many areas as possible. So I will take it from specimen exam, because then obviously there will be a mix. Okay, so that is the plan for the day. Exam paper reading time, that's not available, Rushdi, anymore. It used to be available only for written exams. Okay, not available anymore. So if you want, I can show you. Yeah. So see, computer-based exams. You just look at the specimen. That's ACCA. The website is like that. Okay, just give it a minute. Have you sat for a paper recently, Rushdie? Okay, so you can say if you want to see the specimen exam in exam style conditions, you should answer the questions presented within a 3-hour time period. Okay, what you're saying was there a long time ago when there used to be written papers, they used to give you 15 minutes extra at the beginning just to go through the paper, but now they can't do that, right? So now if you see, it goes like this. It's just, yeah, so see, if you start your paper, because if they give you the reading time, then it's not like you can't select an answer. No. Back in the day, they won't give you the answer script. They won't let you open the answer script. They'll just give you the question paper. You can read it if you want, but now they can't control that, right? So that's why you don't have that. Okay. Right. So let me start off without wasting any more time. Let's start with this question called Degnis Company. Okay, so that is 139. If you have the revision kit, you can go to that page. Some people ask, what is the best order to do the questions? In my opinion, best order is the order that the examiner gives you, right? Reason is, he gives it to you in a way where you won't get stressed. If you try to do the section C first and then come back and then, mess the order up, chances are that you might get stressed, right? So the best option is for you to go with the examiner's order. Like this, okay? Right, so this is from the area investment appraisal. Okay, so you can have a read through. If you're comfortable with investment appraisal, you can even start. Okay, Dignis Company. So let me read through what it's saying. Okay. So it says here, Degnis Company is a company that installs kitchens and bathrooms to customer specifications. It is planning to invest 4 million in a new facility to convert vans and trucks into motorhomes. Okay. So what they're trying to tell you is, up until today, this company, Degnis, they install kitchens and bathrooms. So maybe like if you have a house, you can call them and you want to renovate the kitchen or the bathroom, they will do that and go. But now what are they thinking? They're thinking, shall we move to another area, another product? Because if you know, in the Western countries, especially in countries like the US, there is a trend where people are turning trucks into homes. Okay, because they don't want to live in one space. They are converting a vehicle into a home so they can basically travel wherever they want and, stay there, right? So this company is thinking, okay, shall we invest 4 million in a new facility to convert vans and trucks into motorhomes? So it's a new project for them. Each motorhome will be designed and built according to customer requirements. Degnis Company expects motorhome production and sales in the first 4 years of operations to be as follows. Okay, so what are we expecting? We are expecting in year 1 to produce and sell 250 motorhomes. Year 2, 300. Year 3, 450. Year 4 also, we are expecting to sell 450 motorhomes. The selling price for a motorhome depends on the van or truck which is converted, the quality of the units installed, and the extent of conversion work required. Degnis Company has undertaken research into likely sales and costs of different kinds of motorhomes, which could be selected by customers as follows. So obviously, we can't charge one price for every motorhome. right? Now, for example, one person will say, I want about 3 rooms and 2 washrooms in the motorhome. Another person will say, no, one is enough. 1 room and 1 washroom is enough. Another person will say, put a swimming pool into the motorhome, right? So each person will have different, what's the word I'm looking for? Specifications, right? So each person, each customer will have different specifications. So depending on what the customer wants only, we can give them a proper price, right? So then they're saying, if you want a basic motorhome, we will charge you 30,000. If you want standard, it will be 42,000. If you want deluxe, it will be 72,000. Okay. Then we have a probability as well. We have a, like somebody has calculated this. They are saying 20% of people will go for a basic motorhome. 45% will go for standard and 35% will go for deluxe. Okay. So that's the selling price. Then we have a conversion cost. What is conversion cost? Now think about it. This is a truck. Okay, so there will probably be seats maybe at the back. So you have to throw that and figure out how to put a bedroom into the truck. So to clean it, to make, now if the metal is a little rusted and all, to replace all of that, there will be a cost that you will have to incur. That is only this conversion cost. Okay, so if you are going to do a basic motorhome, it will cost you 23,000. If you are going for standard, it will cost you 29,000. If you're going for deluxe, it will cost you 40,000. Okay. Then it says fixed cost of production facility are expected to depend on the volume of motorhome production as follows. So we have the selling price, conversion cost, and they're telling us fixed cost is also there. And if how do we get the fixed cost? If you make 200 to 299, so any value between 200 to 299. Maybe you made 250 motorhomes in a particular year, then the fixed cost will be 4,000. If you made about 300 to 399 motorhomes, let's say 320 motorhomes, then your fixed cost will be 5,000, and between 400 to 499 means you will have 5,500. Okay. So they're telling you that about the fixed cost. The Ignis company pays corporation tax of 28% per year, with the tax liability being settled in the year in which it arises. The company can claim tax allowable depreciation on the cost of the investment on a straight line basis over 10 years. The Ignis company evaluates investment projects using an after-tax discount rate of 11%. They're telling you a big story here. Let's look at the requirement. They're asking you, calculate the expected net present value of the planned investment for the first 4 years of operations. They're giving you 7 marks. Now, first I'll teach you how to figure out how long you can spend. Okay, so 7 marks means you can spend 1.8 minutes per mark, right? So 7 into 1.8, you should spend about 12 to 13 or 12 to even 15 minutes for this particular question. Okay, so they're asking you, based on all the information that they've given you here, they're giving you a big story. Okay, based on this, they're asking you to calculate NPV for 7 marks. It's a basic NPV question. Okay, so I told you have to finish this in 12 minutes. So I'll give you about 10-12 minutes. See if you can do it yourself. Don't be scared. Okay, even if it's wrong, it's fine. You can cut it off and do it again when I'm doing it. But just try it yourself. Even if you make a mistake, it will help you next time. Okay, so take about 10 minutes. At about 6:50, I will start the question. So hope you had a go at it. Right. So if you have to do NPV, first of all, you should decide on the cash flows. Okay, you should have the cash flows. So in this case, you can see we have a selling price, we have a conversion cost, and we have a fixed cost. In addition to that, we have our initial investment of 4 million. Okay. After that, I can see that there is a tax story that they're telling me and a tax allowable depreciation story as well. Okay, so let's start with the easiest one. Okay, so first of all, let's figure out what is the selling price. What are they selling this particular product for? Now, the issue that I have in this question is I don't have only one selling price. There are 3 different selling prices. Okay, I can't have 3 different selling price in my NPV calculation. I have to settle for one, right? So the only way I can get one selling price is by taking the average. Okay, and I can't just take the average also because they have given me something about probability. So I have to take into account the probability also. Okay, so how I will do this is, I know that 20% of people will buy for 30,000. Okay, so I will call this my workings. Okay, so we're talking about the average selling price. Okay, now I know that 20% of people will buy at 30,000. Okay, and I know that 45% of people will buy at 42,000. And I know 35% of people will buy at 72,000. So it's like an expected value calculation. So if you can remember what expected values were, we have a look at it in the investment appraisal section of our syllabus. If you can remember what that is, we are applying expected values over here because we have to take into account the probabilities as well as the selling prices. Okay, so then you can get your answer here. That is 20% into 30,000 plus 45% into 42,000 plus 35% into 72,000. Your selling price average is $50,100 per unit. It's the average. Okay, so we now have one selling price. That is what is important because we can't have 3 selling prices when we are doing the NPV. So we took an average for selling price. Now the same problem we have with this conversion cost as well. There are 3 different conversion costs. So again, we need to take an average conversion cost as well. Okay, so again, use the same percentages. 20% of people will go for 23,000. Then 45% of people will go for 29,000. And 35% of people will go for 40,000. Okay, so you can take your average conversion cost, which will be $31,650 per unit. Okay, right. So we have done some part to be able to start the NPV calculation. So let's start that now. Okay, so how does the NPV calculation usually look like? You will have the years on one side. Okay, so we start with year 0, year 1, year 2, year 3, and year 4. Okay, and now we can start with the sales figure. So we know that the sales units in year 1, it was 250. Year 2, it was 300. Year 2, it was 300. Year 3, it was 450. And year 4 also, it was 450. Okay, and we know that the average selling price, okay, let me put it as, okay, the average selling price, that was 50,100. So let me just put it here. Every year, it was 50,100. It's average. Okay. So now if I multiply these two, I can get my sales revenue, right? So let me do the multiplication. Average, or let me just call it the sales revenue. So that is 250 into 50,100. Let me see. The big figure. Right. So because this is a big figure, let me just do this in thousands. Okay, so let me do it's fine since it's all on, let it be big itself. Okay, so that's the sales revenue for every year. I can go ahead and do that. So this is 300 into 50,100, 450 into 50,100, and another 450 into 50,100. Let's just make this a little, yeah, okay. Right, so we have the sales revenue. Now we need to include the conversion cost. Okay, so let me put the conversion cost here. Right. So we knew that the average conversion cost, it was 31,650. So 31,650 every year, it's the same. Okay. So now I know that again, this 31,650, that is per unit. So if I want to know what's the total conversion cost, I have to multiply it with the number of sales units. Okay. So that is 250 into 31,650. Likewise, here it will be 300 into 31,650, 450 into 31,650, and another 450 into 31,650. Okay. So we have all the figures that we need for average selling price as well as total conversion cost. Okay. Right. So now to make things a little neater, let's do the net present value. Let's keep this as a working itself and let's do the net present value in thousands. Okay, so this is in thousands. So selling or sales revenue. Yeah, not 1, 2, 3, 4, right? So sales revenue here, it was 1,252,000, no, sorry, 12,525,000. So let's just do it in thousands. That will be 12,525. Here it will be 15,030. Then it will be 22,545 and 22,545. Then let's take the conversion cost. Okay, so this is 7,912,500. So we can round it up to 7,913. Then 9,495, 1,424, round it up to 3, and 1,424,3. Okay. Right. So we have the conversion cost as well. So this entire paragraph is done. Then they're saying fixed cost of the production facility are expected to depend on the volume of motorhome productions as follows. They're saying fixed cost in thousands. Actually, the reason why I made this NPV into thousands is because I saw fixed cost was being 1,000 per year. Okay, so if I didn't do this, this is going to become 4 million, 5 million, 5.5 million. It will become too big, the numbers. So that's why I decided to put the NPV in thousands. So this is something that you should be able to do at your exam. Yeah, sure, Amina. It's already live on YouTube. So probably after the session is over, it will be available. Okay. Right. So we have the fixed cost. Right. So they're saying if you make between 200 to 299, it's going to be 4,000. So in year 1, we made 250. That's between 200 to 299. So this is 4,000. Okay. Then in year 2, we are making 300, which is in this band, 300 to 399. So this will be 5,000. Then in year 3, we are making 450, which is in the third band, 400 to 499. So here it will be 5,500 and the same goes for year 4 as well. Okay, so we have included the fixed cost also. Now at this point, it's a good idea to take a total. And we call this total before tax cash flows. Okay, we call it the before tax cash flows. So let me take the total here. 12,525 minus this minus 612. So for all 4 years, you need to get the before tax cash. Right? Now they're telling me about the tax. They're saying Degnis company pays corp tax of 28% per year and the tax liability is settled in the year in which it arises. So I can put tax over here at 28%. Right? So the tax is 28% of this before tax cash flow, which is 612. Okay. So same for all the years. So 28% of 535, 28% of, 1 second, let me just check these figures. Uh, 12,000, yeah. 28% of 535, then again 28% of 2,802 for years 3 and 4. Okay. So the tax liability, it will be, let's do this as a whole number. So it will be 171 for year 1, 150 for year 2, 785 for years 3 and 4. Okay, right. So if you haven't taken this down, take it down till this point. After that, I will do the tax allowable depreciation calculation. Okay, so take about 2-3 minutes. If you haven't taken it down, take it down now. Right. So this tax allowable depreciation story, I will do another question with a big tax allowable depreciation. In this question, they have simplified it for me because they're saying tax allowable depreciation is on a straight line basis over 10 years. Okay. So all we have to do is to calculate the tax savings that you make from tax allowable depreciation. Now, I have a feeling some of you might not know what this is. So I'll go to one of my slides to just explain this. Because if NPV comes, definitely tax allowable depreciation will come. Okay. So let me tell you what I'm talking about. Oh, not here. Okay. Now, some of you might not know the tax paper. That doesn't matter. The only part of the FM syllabus where they talk about tax is in this area when we're trying to do NPV. So whatever you need to know about this tax, I will explain it right now. Okay. Now, this is the situation. Okay. Now, usually when we are calculating taxes, this is how we do it. Okay, when we have to calculate the tax that we have to pay on a particular profit that you made, this is how we go about the calculation. So what do? Let's say our operating cash flow was $1,000. Okay, let's say that it is $1,000. We have a small problem when it comes to calculation of tax. The problem is the tax authorities, they don't allow you to recognize depreciation as an expense. Okay, they don't allow you to recognize depreciation as an expense. Now, what I'm trying to say is usually in accounting, when we buy a non-current asset, we put that in the balance sheet and every year we release a portion of that as in the form of depreciation. So depreciation is actually an expense in your accounts. But the problem with depreciation is it can be manipulated by people. You know, they can change the method, they can do whatever they want and they can manipulate this depreciation figure. Now, the problem that the tax authority has is if this depreciation is manipulated, it will directly impact the profit because this is an expense, no? So if I want to reduce the profit, now obviously when it comes to calculation of tax, everybody wants to reduce profit because then only the amount of tax that you pay will also be low, right? So in this situation, I might do something and increase the depreciation, increase an expense. Okay, so the tax authorities, they want to avoid that. They don't want that to happen. So what do they say? They say you can't recognize depreciation as an expense when it comes to calculating profit for tax purpose. Okay. Now, obviously, this results in a problem because now people started saying, how can you not have depreciation? Because anyway, that is also kind of an expense, right? So then what did the tax authority say? They said, okay, fine, no depreciation. You can recognize another expense called tax allowable depreciation. This is also similar to depreciation, but the tax authority will tell you exactly how to calculate this tax allowable depreciation. So there is no way for you to manipulate this figure because they are telling you how to calculate it. You can't say, I chose the straight line method, I chose the reducing balance method. You can't say anything like that. They will tell you this is how you calculate it. You have to calculate it that way. Okay. So now what we do usually, if we have an operating cash flow, we tend to deduct the tax allowable depreciation. There is another name for it called capital allowance also. Same, means the same thing. So the tax authority will say, okay, for you, tax allowable depreciation is $200. So you can deduct that from your cash flow. So what happens? Your profit that you have to pay tax on, it reduces. It's not 1,000 anymore. It becomes 800. It becomes 800. Okay. Now on this 800, let's say corp tax is 30%. 30% of 800, 240 will be the tax that you will have to pay the Inland Revenue Department. In the UK, it's called HMRC. Okay. So if you want to know NPV, now when it comes to NPV, this part is a tax problem, right? We are not concerned about that. But when it comes to the financial management paper, we just want to know what is the cash inflow. So what will we do? We know that 1,000 is an inflow, 240 is an outflow in the form of tax. So net cash inflow will be 1,000 minus 240, which is 760. Right? So that is what we do when it comes to real life. This is how we calculate taxes. But for this paper, if you do it this way, we end up making a lot of workings. There will be a lot of workings because we do NPV for many years at a time. Right? So if we are going to do this for every year, year 1, year 2, year 3, year 4, all the way to year 8, it's going to take a lot of time. Right? So we figured out another way to do the same calculation. So what do? We have the net operating cash flow, 1,000. We directly calculate tax on this 1,000. So we don't consider the tax allowable depreciation. We directly calculate 30%, which is 300. Then what do? On this tax allowable depreciation, which we knew was 200. How did we know that's 200? Tax authority told us how to calculate it. We realized that this is an expense. No? So any expense will reduce your profit. Anything that reduces profit will reduce the amount of tax that you end up paying. So this tax allowable depreciation of 200, it will actually result in a tax savings of 30%. It will result in a tax savings of 30%, which is a savings of $60. So since it's a saving, we put it as a positive figure. Okay. And then when you take your net cash flow, you can see you will get your 760 that we calculated previously as well. Okay. So when it comes to FM, if we want to deal with tax allowable depreciation, first you have to calculate what that figure is. In this case, we knew it was 200. Most of the time we have to calculate it in our exam. After that, based on the tax allowable depreciation figure, we have to multiply it with the tax rate. And that will give you the tax savings, which we have to include in the NPV calculation. Has to be included in the NPV calculation. Okay. So now in this question, if you see what they're saying is it like a deferred tax asset? No, it's not like a deferred tax asset. Okay. Here, the only thing is we are trying to figure out what is the cash flow. We are not concerned about the tax implications whatsoever. Whether you pay early or late, that is up to you. But we want to know, okay, what is the overall inflow when it comes to this particular asset? One thing about FM, guys, you have to little forget financial reporting. I always say this in my first class. You have to forget financial reporting a little because the way we think is a little different. Okay. For example, in financial reporting, we think in terms of profits and losses. Here, we don't care about profits or losses. We are more concerned about whether we can predict properly or not. Okay. So yeah, this is just about figuring out what is the cash inflow for that period. Because for NPV, cash inflow is what's important. Okay. Right. So let's go back to our question. What does it say? So it's saying here, the company can claim tax allowable depreciation on the cost of the investment on a straight line basis over 10 years. Okay. So we need to have a working for tax allowable depreciation. So I'll just take it down. So what are they saying? This tax allowable depreciation, it's going to be on the cost of the investment on a straight line basis. So we know that the cost of the investment was 4 million. So straight line basis for 10 years means we are talking about 4 million divided by 10. Okay, so the tax allowable depreciation is going to be 400,000. That's the tax allowable depreciation. But that's not the figure that we put in the NPV calculation. What we put in the calculation is the tax savings on this 400,000. So we know that we were paying tax at 28% per year. So the tax savings will be 28% of this 400,000. So that will be 112,000. This 112, it goes as a positive figure in your NPV structure. Okay. So we can put tax savings here. So every year, since there was no arrears or anything, we were paying on the same year, we will have an inflow of 112 every year. Okay. Right. Taxes actually, if you want, I think it's better. I'll make these figures. Now, if I make it negative, I won't be able to formulate it, right? So let it be like this. But remember, conversion cost, fixed cost, tax, they are negative figures. Tax savings is a positive figure. Okay. Right. So now we have included everything they mentioned, if I'm not mistaken. Okay. So which, is there a part that you didn't get? Average price. Doesn't matter. Doesn't matter, Ashad. If you can get the answer, yeah. If you can get, did you get the answer? Then it's perfectly all right. Okay, if you want, you can just show me to see what you did. But if your answers are there, there's no one way. More time is going when you do it your way. Can you show me what you did? Or just explain what you did? Okay. Right. So I think we have everything covered. Right. So let's take a total. Okay. Ah, yeah. One thing we forgot. We forgot about the investment, right? So it's planning to invest 4 million. So let me put the investment as well. So that was year naught. Obviously, any investment will happen in year naught. A negative 4 million means we can put it as 4,000. Okay. Right. So now I think it's time to take a total. So let's do that now. So I can't put the line here. So let me just do it here. Right. So what we call that is we call it the after tax cash flow. Okay. So here it will be just minus 4,000. Here it will be 612 minus the tax plus the tax savings. 553. Same thing for all the columns. Minus the tax and plus the tax savings. So here it will be 535 minus 150 plus 112. The next year it will be 2,802 minus 785 minus plus 112, and the same will happen for year 4 as well. Okay. So we have all the after-tax cash flows. Now what we have to do is we have to take the discount factor at, I think they give you the percentage, which is 11%. Okay, 11%. So here not, it's always going to be 1 because it's already a present value. Years 1 to 4, you have to go to the present value table and find out what is the discount factor for 11% from year 1 to year 4. So let me show you that table quickly. Okay, this is what the table looks like. Present value table, you have to go to 11%. Year 1 to year 4, the numbers are there, 0.901, 0.812, 0.731, and 0.659. So you have to copy that here. 901, 0.812, 0.731, and 0.659. Okay. So now you can take the present value at 11%. So multiply all the numbers, right? So minus 4,000 into 1 will again be minus 4,000. You have to multiply for all the years. Okay, so 553 into 0.901, 497 into 0.812, and so on for years 3 and 4 as well. So let me just round this up as well. Okay. Right. So now last step is to calculate the NPV. Okay, so NPV, that will equal to minus 4,000 plus 498 plus 404 plus 1557 plus 1403. So that will be a negative 138. Okay. So over here itself say, since NPV is negative, reject the project. Just saying reject or accept will give you 1 mark. Okay. So don't ever forget to say that. Okay. This is also another working. So what we can do is we can take this up. Okay, so just clean everything a bit. Since everything is computer based, we don't have that problem anymore. If not, those days we used to have a problem. We had to leave a first page and all that. So now you can take this up, keep that under the workings, and then bring this table up as well. Okay. So we have the workings and the NPV. If you want, you can do this as well. Yes, I was going to do that, Rushdie. So yeah, it's 7:20 now. You can take your break because anyway, this is a 3-hour class now. So come back at around 7:40 and we will continue with the other question. Okay, so I'll leave this on the screen. Once you pray and come, you can copy this down. Okay. Astrid, also, I will look at what you have done in a bit because I assume you also have to pray. So once you're done, I will look at what you did. Okay. Yeah. So take a break. Come back at 7:40. Right. So yes, as Jed, you got it right. The conversion cost, you put the wrong figure that I didn't notice. The tax savings, you have used the wrong method. They had mentioned that it was the straight line method. Okay. Right. So yeah, let's move on. This question is not over. What does it say? They're saying A part is done. So if you do this, you will get your 7 marks. Okay. Now B is telling something interesting. So they're saying after the 4th year of operation, the Ignis company expects to continue to produce and sell 450 motorhomes per year for the foreseeable future. That means from the 4th year onwards, meaning year 5 onwards, we are going to sell 450 motorhomes forever. It's a perpetuity. Okay. So the requirement is stating calculate the effect on the expected NPV of the planned investment of continuing to produce and sell motorhomes beyond the first 4 years and comment on the financial acceptability of the planned investment. Okay. Now, although this is just 3 marks, it's actually a lot of work. Like, I mean, if you don't know about how to get a present value of a perpetuity, you will be completely lost here. Okay, so that is the importance of doing past exam questions, because only then you would have seen something like this in the past. When you see it in your paper, you will realize what to do. Okay, so it says 3 marks there. So you should be done in about 5 minutes. In fact, the calculation is simple. There's nothing much. But if you don't know about present values and how to work around it, you will definitely have a problem. Okay, so you can see in this 20 marks, 10 marks has been clearly given for calculations and another 10 marks has very clearly been given for theory. So understand that to pass this paper, calculations alone is not enough. Theory gives you 50% of your marks. And in fact, when it comes to MCQs, it's easier to score theory-based MCQs rather than the calculations. Okay, so you have to give equal importance to both. Right, so I'll give you about 5 minutes. See if you can figure out how to do the B part. Okay, I hope if any of you want to take this down, you can. But I assume you have already taken the NPV calculation down. Yeah, one more important thing, right? Now this B part, 3 marks, right? Now, if you don't know it, don't spend 20 minutes in your exam trying to figure it out. Leave it and go to the next question. Keep going. If you have time in the end, you can come back, right? So give the 5 minutes. If you can't figure it out, move on. Because by spending 20-30 minutes, you will end up having about 3/4 or half of your paper just empty. So don't make that mistake also. Okay. Let me know if you get the answer. Right. So let me explain what they are saying here. Right. So they are talking about a period after what we calculated. So they're saying after this 4-year period, what's going to happen? Right. Now, at the 4-year mark itself, if you look at your question, we were already selling 450 units. We were already selling. So that means from 4 years to the foreseeable future, we can expect this cash flow of 2,802. Okay. And I mean, we are making an assumption that the tax will be 28%. We can assume that this will also be 785. Okay. So let me put the situation in a timeline. Okay. So the B part. So B is saying that after tax cash flow from year 5 to perpetuity. Why am I saying perpetuity? Because they're saying for the foreseeable future. So forever, we are expecting this to happen. 2,802 minus 785, which is the tax rate. So we are expecting a an after-tax cash flow of 2017 per year. Okay. So that is yes, we'll just leave it like this. If not, you won't see the working, right? So 2017 per year. So let me put this in a timeline. Okay, it will make more sense to you then. So we are talking about, if this is year naught today, we are saying from year 5 to perpetuity, forever, we will be getting 2017 every year. That's what we are trying to say. Now, if they're asking you in the question to calculate the NPV, right? What is the expected NPV? So NPV means whatever cash flow you have to bring it to year nought's terms. You have to make it a present value. I'll come to that, Ashton. Why didn't we adjust the tax savings? I'll come to that in a bit. Okay. So year naught is the year that we have to bring this particular 2017 to. Now, this is a perpetuity. Now, to calculate the present value of a perpetuity, this is the formula. You have to remember this. Equals the perpetuity into something called the perpetuity factor. The perpetuity, which is 2017, multiplied by the perpetuity factor. Now, if it was an annuity, for example, it will be annuity into annuity factor. If it was a normal cash flow like here, it will be the cash flow into the discount factor. Now, discount factor, annuity factor, we have tables, right? Perpetuity factor, we don't. The reason is the equation for perpetuity factor is very simple. It's 1 over R. Okay. So, if I want the present value of a perpetuity, it will simply be 2017 into 1 divided by, in this case, R was 11%. Okay, it will be 2017 into 1 over 11%. So that will give me 18,000. Okay, this was actually in millions. So I'll just put the million figure. This also will make it in millions itself. Because earlier NPV, we did it in thousands, right? So 18,336,363. Okay, but there is a catch. Remember this. Whenever you use an annuity factor or a perpetuity factor or a discount factor, whatever it is, it will bring the future value back only by 1 year. Okay, so this 2017, it will bring it from year 5 to year 4. So this year 4 value is only this 18 million, right? But we don't want the value in year 4's terms. We want it in year nought's terms because we want the present value, right? So for that, what do we have to do? This 18.336 million, you have to multiply it with the discount factor at 18% for 4 years. That will bring it back to year nought's terms. Okay. So I will do that now. The discount factor for 11%, let me have a look, 363. Discount factor at 11% for 4 years, right? If you want, have a look at the tables. Okay, so that will be 0.659. Okay, so the present value we're talking about is 12,083,664. Okay, right. So Astrid had a question. Why didn't we include this tax savings figure? The reason for that, Astrid, is tax savings is a direct result of tax allowable depreciation. Okay, it's really happening because of this tax allowable depreciation. Now, tax allowable depreciation will be given to you only for a period of 10 years. Okay, whereas these other cash flows, which is your before tax cash flow and the tax, that will happen to perpetuity. Okay, so when you're doing the discounting, you have to do the discounting for the tax savings separately because there is a fixed period. We're talking about a 10-year period, whereas when we spoke about the cash flows, we were talking about perpetuity. So that's why we can't take them both together. Okay, so now you can try to get the present value of the tax savings, right? So let me talk about that here. Right, so if you're talking about tax allowable depreciation, it was a benefit that you will have for 10 years, but already 4 years we have recognized it. Okay, for 4 years we have already recognized it. So now the remainder of 6 years only, we will have this tax allowable depreciation benefit. Okay, so 6 years of benefit we can enjoy. So these 6 years, we know that it is a fixed cash flow for a fixed period of time. This is not a perpetuity. This is something called an annuity. Okay, so now that I have told you what it is, I'll give you 2 minutes. See if you can get the present value of the annuity before I do the question. So earlier we got the present value of a perpetuity. Now we are trying to get the present value of the annuity. Okay. Always when you're trying to do present values, it's always a good idea to draw a timeline somewhere. You don't have to show it on the Excel sheet itself. But you know, if you have it on a sheet of paper somewhere, you won't go wrong. Okay. There is a reason why I chose this and actually the next question that I'm doing. The reason is NPV, in addition to the NPV main calculation, another sub area is called a lease versus buy decision, which you must be knowing about. And another one is called EAC, equivalent annual cost. And then you have this area as well. Okay. So equivalent annual cost, it was already tested in March. Okay, it was a kind of like a shock for people, but it was tested. So, I mean, I'm not saying don't go through equivalent annual cost, do go through it, but it's a good idea to go through lease versus buy this area as well. Okay, lease versus buy, I'll do it next week. This week, I want to look at how to properly do the discount. Right. So this is an annuity. Like I said, the tax allowable depreciation, if I remember right, the tax savings was 112. Okay. So every year you're going to make a savings of 112. The first 4 years we have already accounted for it. So we are only interested in year 5 onwards. So 112 in year 5, year 6, year 7, year 8, year 9, and year 10. It's an annuity. Okay. Now there's a reason why I have written every year like this, right? If I had just written year 5 and year 10, you might think that the annuity is 5 years. Okay, but be careful. If you look at it carefully, year 5 is 1, 2, 3, 4, 5, 6. So there are 6 annuities that are happening. I mean, 6 cash flows that are happening in this annuity. So you have to do the annuity factor at 11% for 6 years, right? Not 5 years. Always take into account the number of cash flows when you're deciding the number of years. Okay, so that was a learning point. Right, so we're talking about present value of an annuity. That's the cash, the annuity into the annuity factor. Annuity factor, there are tables, right? So here we know that the annuity is 112,000 multiplied by annuity factor at 11% for 6 years. Okay. So 112,000 annuity factor at 11% for 6 years is 4.231. So that will give you 473,872. But careful, right? Because this will only bring the annuity back by 1 year. Okay, that's not what we want. We need it to come back to year naught. So this is just bringing it back 1 year, and that is only the 473,872. So what I have to do is I have to further bring this back to year naught. But 473,872 is just a cash flow. It's no longer an annuity. So you have to multiply it with the discount factor. Okay. So 473,872 into discount factor at 11%. So this time, careful, from year 4 to year naught. So we are talking about discount factor at 11% for 4 years. Okay, so 473,872 discount factor 11% 4 years. You have to look at the present value table. It is 0.659. So that will give you 312,282. That's the present value. Okay. Now, if you want the net present value, we have two numbers. One is you're going to get a benefit because of these after-tax cash flows, cash inflows no there. So there is going to be an overall inflow of 12,083,664. So I'll put that here, 12,083,664. But that's not it. In addition to that, you will also get this benefit from the tax savings, which is 312,282. So overall, the net present value, both were present values, I add it up together. The net present value is 12,395,946. Okay, that's the situation. Now read what they're asking you. They're saying calculate the effect on the expected net present value of the planned investment of continuing to produce beyond the first 4 years. Now, if you look at the first 4 years, we calculated the NPV as negative. Okay, it was negative, 138,000 negative. So we said reject it. But look at it from year 4 to year 10, it has become a positive 12,395,946. What that means is maybe you won't have cash flows in the first 4 years, but after that it is going to pick up. And when it does pick up, it's going to give you a huge inflow of cash. Okay, so if you're okay with your money being invested for about 10 years, then by all means, you can go ahead with this project. Okay, now you might ask, okay, then why are we using this NPV? It's giving you a wrong result, right? The thing is, usually NPV, we do it for the entire life of the project. So if you are going to do it for 10 years, we do it for the entire 10 years. Whereas in this question, they made us only do it for 4 years. That's why it's showing negative. Whereas if they had made us do it for 10 years, this NPV would definitely be a good positive figure. Okay, so that is what you have to say here. Okay, so you have to write this. If you don't write this, you won't get the last mark. So you can say, if you consider the first 4 years of the project, the NPV is negative. Okay. After that, you can say, but if the first 10 years of the project is considered, it is strongly positive, right? It's not even a small positive figure. It's strongly positive. Therefore, based on this, the project can be accepted. Okay, so you have to give this last point. If not, you won't get your marks. Right? If you haven't taken this down, take it down quickly. So this was the perpetuity. And after that, we had the annuity. Next two parts are actually interesting. It's the area where people have problems because we are not comfortable typing in answers, right? So let's see. So I'll just give you a minute in case you haven't copied any of this. Okay. So let's go to the last two parts, right? Now it's saying here, critically discuss the use of probability analysis in incorporating risk into investment appraisal. Okay, now first thing is there is a key word here. Critically discuss means you should give more disadvantages than advantages. You can give one advantage if you want, but most of the marks they will give you for disadvantages. If they just say discuss, then you can give 2 advantages and 2 disadvantages and call it a day. But here they are saying critically discuss, right? So that means about 3 marks will be for disadvantages of probability analysis. Now, why are they asking this question in the first place? Because in this question, one of the basic things that we took into account was this probability. We started off our question itself with the probability. So they are asking you, why is it risky? I mean, what is the disadvantage of incorporating probability into a question like this? Okay. So how do you answer this? It's giving you 5 marks. Okay. Now, first thing I will tell you is, if you have 5 marks, first 1 mark they will give you for some kind of definition. Okay, so in this case, you can either define probability analysis or you can define risk. One definition, definitely they will give you a mark. Then critically discussed. So one can be an advantage of probability analysis, or even if you don't have that, it's fine. You have to give about 3 to 4 disadvantages of probability analysis. Okay, right. So if you look at your marking scheme, they start with defining risk. Okay, so what do they say? They say risk in investment appraisal refers to a range of outcomes whose probability of occurrence can't be quantified. So we speak about this, right? Where we talk about risk and uncertainty, right? So basically they are giving you the exact definition of risk. That will give you 1 mark. After that, they're saying probability analysis can be used to calculate the values. Let me just go through this. Okay. They are defining probability analysis as well. Just give me a minute. I'll show you the marking scheme in a bit. So first they define risk, then they define probability analysis. Now they are going to start speaking about the disadvantages, right? Now, first disadvantage when it comes to probability analysis is we can use probability analysis or expected values. If you remember, you can use it only if you keep on taking the same decision again and again. Like, for example, you're selling something or, you're buying something again and again, like something like inventory. You can't use probability analysis for a one-off decision. Okay, now investing in this project, this 4 million investment, it's a one-off decision. You take it or you don't take it. After you take it once, you're not going to keep on investing 4 million, right? So usually probability analysis is only good for repeated decisions. It's not good for a one-off decision. So that is a disadvantage of incorporating it into investment appraisal, because usually investment appraisal is a one-off decision. Okay. The other thing is the disadvantage with regard to probabilities is this 20%, 45%, 35%. Now this point anybody can get, right? It's very difficult for you to calculate the percentages, because how are we going to decide on what basis it's going to be 20%? On what basis is it 45%? How do we know that it's 35%? So calculating a probability is never an easy task. So that alone is a disadvantage of using it in investment appraisal. And finally, if about 2 to 3 people calculate different probabilities, each person will come with a different answer. Like, for example, person A will say 20% will buy basic. Person B will say no, 25% will buy basic. So the problem is the probability that you calculate, it is subjective, meaning it will change when people change. Depending on the person who does the calculation, the value will change. So that again can be considered a disadvantage. Okay. So if you can mention, not reasonalized, yes, right. So if you can mention this, not rationalized. What do you mean by not rationalized? Okay. So if you can mention these points, about 5 points, if you can mention, that should give you your 5 marks. Okay. So let me quickly go to the marking scheme to show you what they have, right? So this is page 368. Okay. 368. Okay. Right. So this is the C part, right? So you can see first, when you will also, find yourself going through marking schemes, right? So always make it a point to just read the ones that are highlighted. Okay. Because this is an answer written to you by your examiner. And he always says that what he writes is a 120 mark answer. What that means is, if you want to get 120 marks for your paper, you have to write like this, meaning it is much more than what they expect. So if you want 100 marks for your paper, then you just have to, write what is highlighted. So I don't want you to, get confused reading everything. Just read the highlighted points, right? So you can see first he has defined risk. Then he is defining probability analysis. You can write anything about probability analysis that you know. Then he's talking about difficulties. See, probability analysis, the first difficulty is its assumption that an investment can be repeated a large number of times. We make that assumption. In reality, many investment projects, you can't repeat it. Okay. Another difficulty is the question of how the probabilities and possible outcomes are assessed and calculated. And the third one, assessing probabilities this way is likely to be very subjective, meaning depending on the person who does it, it will keep on changing. Okay. Right. So this is basically how you would answer a question. So how do you get good at theory-based questions? There is only one way out. You have to read many questions and read answers to those questions and learn them. Okay, because understand one thing. If you're a person who is marking a paper, you will have something in mind, right? Now, calculations, this problem is not there, but you will have something in mind, meaning there is something that you will look for. So an examiner also, when he's reading your answer, he is looking for something. And what he's looking for is basically there in the marking scheme, because he is the one who wrote this answer. Right? So if you write something that came out of his head, chances are that he will definitely mark that correct and give you the mark quickly. If you try to write something out of your head and that is not correct, then anyway you won't get your mark. But even if it is correct, sometimes if the examiner can't understand your language or there is some barrier there, it might result in you not getting your marks. Okay, so that's what I'm saying. The best way to tackle theory is to go through what he's saying and repeat it back to him. Okay. Right. So let me look at the D part. Take this, right? Can't remember the question. One second. It's 138. Right. So that's the C part done. D is saying, discuss reasons why investment finance may be limited even when a company has attractive investment opportunities available to it. So this D part is not connected to the question. They're just asking some random question. They're asking you, you have a lot of investment opportunities. Okay, there may be so many projects that you can invest in. Like this example, they're asking you, even though you have investment opportunities, why will you be short of finance? Why is there a reason for that? That's the question. For 5 marks. Okay. What do you think you can say for 5 marks? So like I said, 5 marks means the first point, it has to be just a general point. Okay. Now, when I look at this question, I can see they're just unnecessarily saying something. They're saying, even when a company has attractive investment opportunities, they can just ask like this. No, they can ask, discuss the reasons why investment finance can be limited. That itself is a question. But they're just saying this extra thing to it. So I can build something with that. So I can just say, if you have attractive investment opportunities and they give you positive NPVs, then investing in those opportunities will definitely increase your shareholders' wealth. I can say that. But regardless of this, there can come a situation where I am unable to do it. Okay. So one reason, actually there is a theory behind this. If you can remember, it's called capital rationing. Okay. So there are 2 reasons why we can have limited finance. One is called hard capital rationing. That means somebody external to the organization, they are giving us a limit. Now, for example, maybe we have borrowed a lot from the bank. Okay, we have borrowed a lot from the bank. So now our debt is pretty high. So after this, even if there are attractive opportunities, the bank is not willing to lend the money to us. They have said, no, that's it. If you want, you settle all your loans and all of that, and then we'll think about it. So in that case, what has happened, somebody external to the organization, they have given you a shortage. They have, because of a policy of theirs, you have a shortage of your finance. So that could be one reason why investment finance is limited. Another reason is called soft capital rationing. So just saying hard capital rationing and soft capital rationing will give you your 2 marks. Okay. So soft capital rationing is when within the organization, we ourselves impose a limit. Now, for example, we might have different departments. We might say the quota for your department is 1 million. Okay. For your department is also 1 million. So likewise, we fix a specific quota within the organization. And the reason why we do that is not because we don't have money, but because we want to make sure that they kind of compete with each other. Because if we give somebody unlimited finance, they will just do whatever they want with that, right? If we give them limited finance, they will make sure that they invest in only the best projects. So that's the reason why we have this soft capital rationing theory. Okay, so if you can just mention this, right? You mentioned the fact that if you have positive NPV projects, you have to invest. It will increase your shareholder wealth. If you can explain a little bit about hard capital rationing, a little bit about soft capital rationing, 2 marks each, it will give you your entire 5 marks. Okay, so that's about the 20 marks for this particular question, right? If you want, I can show you the marking scheme. 369. Yeah. So here, see, theoretically, a company should invest in all projects with a positive NPV in order to maximize their shareholder wealth. If finance is limited for reasons outside a company, it's called hard capital rationing. And you can just explain a little bit of it. It will give you 2 marks there. If the funds are limited for reasons within a company, then it's called soft capital rationing. Little bit. You don't have to explain this. Just one more point. Just talk about maybe giving a quota for each department to make sure that only the best projects are invested in. That will give you 1 mark easily. Okay, so look at the marking scheme here. For your NPV, your sales income, conversion cost, before tax, tax liability, tax allowable depreciation benefits, after tax cash flows, and your NPVs. All of that will give you 1 mark each. Then here, present value of future cash flows, ignoring tax allowable depreciation. So first you have to figure out that TAD has to be ignored because the time period is different. Just ignoring itself will give you 1 mark. And then calculating the benefits and the financial acceptability, the last point that I typed out, that will give you 1 mark. Here, risk and uncertainty will give you 1 mark. Explanation of probability analysis will give you about 1 to 2 marks. Then about the repeatability, if you explain that, 1 to 2 marks. And the difficulty in determining probabilities, again, 1 to 2 marks. Here, reasons for hard capital rationing, reasons for soft capital rationing, up to a maximum of 4 marks you can go for. Okay. So that's how you get the 5 marks. Okay. Right. Any questions in this particular area, NPV? Has this question been clear to you? We have another 40 minutes. I'll find a question that we can do in 40 minutes. If you have any questions, let me know now. Okay. I think I have the question, right? So I told you there were 2 areas that I wanted to look into. The other one was something called a lease versus buy, right? So let me quickly go there. It's Spot Company. What's the number? 152. Okay. Right, this one. It's a small question. Spot Company, right? So I'll quickly read through it, but you can see calculation there, 10 marks for just A part. Okay. So it's saying Spot Company is considering how to finance the acquisition of a machine costing 750,000 with an operating life of 5 years. There are 2 financing options. So we have to buy a machine. It costs 750,000. We have to decide how are we going to buy it. Option 1 is we can lease it for annual lease payment of 155,000 per year, payable at the start of each year. So that's one option. Okay, we can go for a lease, or we can buy the machine for 750,000 using a bank loan, charging interest at an annual rate of 7% per year. At the end of 5 years, the machine would have a scrap value of 10% of purchase price. If the machine is bought, maintenance costs of 20,000 per year would be incurred. Okay. A part is saying evaluate whether Spot Company should use leasing or borrowing as a source of finance, explaining the evaluation method which you use. They're saying ignore taxation. I'll give you about 10 minutes. I know it's not enough, but if you know lease versus buy, you should be able to figure out. Okay, I'll give you about 15 minutes because it's a 10 marker. Ideally, for your exam, you can take about 20 minutes to do it. So this is a classic example of the lease versus buy decision. You have to decide, should we go for the leasing option or should we go for the buying option? Have a go. Okay. So I'll just give you the theory a bit. Okay, I've given you about 7 minutes now, but in case you're stuck, I don't want to just waste time with you waiting for me. So let me just explain this lease versus buy. After that, I'll give you some more time in case you want to try it on your own. Okay. So let me go to that area. Capital rationing, actually, we saw it, right? Hard and soft in the previous question. So lease versus buy. Now, this is a actually important area, right? Because either this or that EAC part, equivalent annual cost, I will come to that in another TRG. They will ask because NPV, they know most of you are good at it. Because we have done a lot of NPVs from MA, we are doing NPV, right? So lease versus buy is a little different, okay? So this, like what it, the name itself suggests, we are trying to decide if there is something that we have to invest in. Should we go for a lease or should we take a bank loan and buy it? That's the question, right? So you can see here, leasing, this is to finance the purchase of an asset with the lease contract. Buying is to acquire the asset with separate finance arranged for the purchase of the asset. Okay. So how do we take the decision whether leasing is good or buying is good? So we have to calculate the NPVs of the financing cash flows for both options. For leasing also, we have to calculate like an NPV. For buying also, we have to calculate an NPV. So how do we calculate this NPV? Now remember this carefully. This slide is very important, right? When you're calculating NPV for a leasing question, for the leasing part, there are only two cash flows that you have to consider. One is the lease payment itself. The second is the tax relief on lease payments. These two cash flows you have to consider. So whatever the lease payment is, whatever the tax relief is, it will be future values, right? It will be year 1, year 2, year 3. You have to make it present value and calculate the NPV. And for buying, these are the cash flows you have to consider. The purchase price, the scrap value, and any tax savings from tax allowable depreciation. Okay, these two things you have to consider. In addition to this, if there is any other specific cost that is to do with buying that machine that you will have to incur, that also you have to include. And it says in both cases, the post-tax cost of borrowing should be used. And how do we calculate that? It's the cost of borrowing into 1 minus the tax rate. Okay, so what is important is for you to identify these cash flows. Now, in this question, it's made easy for you because they tell you ignore tax. Okay, so the tax relief on lease payments and tax relief on tax allowable depreciation, it's ignored. So the only thing you have to consider is the lease payment as well as the purchase price. Okay, so keeping that in mind, if you are stuck at this point, you can again read it and see it might make sense. Okay. So take about 5-10 minutes if you can figure it out and let me know the answer. Good question, Rushdie. Now, usually when it comes to a lease, this maintenance, now you're renting it from somebody, no? So think about a machine or something, you're renting it from somebody. The owner only will usually send somebody for maintenance. They will have expert people who are good at maintenance. They will come and maintain the machine for you. That's the usual scenario. And you can see in option 1 also, they don't talk about maintenance, right? But if you buy the machine yourself, you don't have anybody to look up to like that. You have to do the maintenance yourself. So that maintenance cost, it's going to be a cost in your NPV calculation. Okay, so normally if you are going to go for a short-term lease, you will get this, the maintenance will be done by the owner himself, unless the question states it. So here, since it's not stated, we don't have to consider maintenance in option 1. Actually, you can keep that in your mind, can be an answer for B part. Okay. Okay, so let me start, right? I have to go for a lease versus buy. So option 1 was the lease, right? So let me calculate an NPV for this option 1. It's a lease. So they're saying, I can lease this machine for an annual lease payment of 150,000 per year, payable at the start of the year. Okay. And how many years is the operating life? Operating life is 5 years. Okay. So always good idea to draw your timeline once again. If not, there is a chance that you can go wrong. Okay. So we start at year 0, year 1, year 2, year 3, year 4, and year 5. Now be careful here, right? They're saying we are paying 150,000 at the start of the year. That means the first payment doesn't start in year 1, because start of the year means it's the same as end of year 0. So actually the first payment happens in year 0, 155K. Then year 1, you get another 155,000, another 155, 155, 155. Careful again. We're talking about 5 years, and we're talking about an annual lease payment for 5 years. So if you look over here, from year 0, year 1, year 2, year 3, year 4, at year 4 itself, the 5th payment is over. Okay, so don't take year 5 also, because then it will become a 6-year lease. In this case, there is an operating life only of 5 years. Okay, right. So now, you don't think that in year 5, we don't make a payment, right? Making a payment at the end of year 4, the last day of year 4 is the same as the first day of year 5. Okay, so for us, the problem is happening because we are concerned about the exact year. Okay, right. So this is an example of what we call an advanced annuity. Very good, Rushdi, right? It's an advanced annuity. So how do we get the present value of an advanced annuity? It's very simple. You use the annuity factor. Okay, but you can't use annuity factor for year naught because year naught is already in the present value itself. So what you do is for these four, the annuity for 4 years, you multiply it with the annuity factor at how many percent? Let me see. What was their rate? Bank loan charging interest at annual rate. Okay, the only rate that we have is this 7%. So that's what we have to go for. So we have to find the annuity factor for 4 years at 7%. So present value equals to 155,000 into annuity factor at 7% for 4 years. Okay, so look at your annuity table. Annuity factor 7% for 4 years is 3.387. 3.387. So that will give you 155,000 into 3.387. It will give you 524,985. So that is just these 4 annuities. Year 1 to year 4, it has come to year naught. That's fine. But in addition to this, we have to include year naught's cash flow as well. So you have to add 115,000 to this. So the NPV is going to be 524,985 plus 115,000, which is 639,000. Let me just check, okay, once more. 87, sorry, 155. I put it as 115, okay? 679,985. That's the NPV. Now think about it like this, right? This is a cost. 155,000 is something that we have to pay. So this NPV is actually a cost. Okay. Okay, let me see what you have here. Okay, so the first mistake I can see after this, you have put 155,000 for year 5 as well. That would make it 5 years. That will make it 6 payments. So that's the first mistake. Option 2, I will have a look at it in a bit. Okay, so everything is fine. Only thing is you should not have it for year 5 because the first payment started in year not end. Okay. Right. Let's go back here. So we have the NPV of the leasing option. So let me do the buying option as well. Option 2, buy. This is just a normal NPV, right? So we have the years. Let me just put the years this way. 0. And then in year naught, we will have an investment, right? So cash flow. An investment of 750,000. Okay. Then in years, so they're saying you can buy it for 750,000 using a bank loan charging interest at 7%. At the end of 5 years, it will have a scrap value of 10% of purchase price. So 5 years, you will have scrap value. So this is investment. Here you will have scrap. How much is the scrap going to be? 10% of purchase price. So that will be 75,000. Okay. Then they're saying if the machine is bought, maintenance of 20 per year would be incurred. So that means from year 1 to year 5, you will 1 to 5, you will incur a maintenance of how much? 20,000. So careful. This is an annuity. These are just normal cash flows. Okay. So investment is just a normal cash flow. Scrap is just a normal cash flow. But maintenance is an annuity. In fact, it is negative 20,000. Okay, so now you can use a discount factor or annuity factor, whichever is correct, at 7%. Okay, so year naught is always 1. 1 to 5, obviously annuity factor for 5 years at 7%, that will be 4.1. And here we are talking about discount factor for year 5, 7% again, 0.713. Okay, so take your present values. It's basically this figure into this figure for all the columns, all the rows rather. Okay, so you can take your NPV which will be this plus this. That is a negative 778,525. Actually, even this NPV is negative only, right? Because 155,000 is a payment. So I'll just make this negative. Oh, sorry. I'll just write it down here. I don't want to waste time. Okay, so this is also a negative 679,985. So how do we take the decision, right? So the leasing option, it is making you pay 679,985, whereas the buying option is making you pay 778,525. So leasing is making you pay less. That is the one you will go for. Okay, so you will say leasing is cheaper since the present value of leasing is how much less? Let me see. 778,525 minus 67,998. Yeah, 98,540. Since present value of leasing is 98,540 less than buy. Therefore, the machine should be acquired via a lease. Okay. This is the lease versus buy decision. Yes, so that was one error. Otherwise, okay. Asjad, whenever you're doing NPV, interest will never be a cash flow. Because the reason for that is by taking the discount factor, we are already incorporating the effect of interest on cash flow. Right now, the difference between a present value and the future value is the interest component. Right? The reason why we have something called present value and something called future value is because if you keep the money for a longer period of time, interest will keep getting added to it. So the impact of interest on your cash flows is already taken into account by the discounting process. So you don't have to take the amount that you have to pay as interest as a separate cash flows ever for any NPV calculation. Okay, so that is the mistake here. Okay. Right. So that's the A part. What does B say? They're saying discuss the attractions of leasing as a source of both short-term and long-term finance. So why do you think a short-term lease or a long-term lease, whatever it is, why do you think it is attractive? Okay. 5 marks, you can split it into 2. Give 2 points for short-term, 2 points for long-term. That will give you your marks. Okay. So I'll just give you a minute. Just think about 5 different points that you can make. Just think about it. And then when I'm just giving you the point, see if it's matching. So first is we have to decide the difference between a short-term lease and a long-term lease, right? Now you don't have to go into the details like in FR. You just have to know the difference slightly. Now short-term means it's like a rent. Long-term means it's a long-term thing. Like it's like basically an installment plan basically, right? So if you take short-term lease, it's like renting. No? So the first advantage and why a lot of people go for short-term is your asset won't get obsolete. Obsolete means it won't get old. Because now you will buy something, an asset, you're renting it, and you will use it. If you feel that, okay, this is a little outdated, you can return it back to the owner and take another one for rent. Think about a car, for example, you're renting a car. For example, you bought the 2014 version of a car. You used it for about 2-3 years. After some time, you realize that there is a 2020 version. It's a lot better. So what can you do? You can simply give this back to the owner and ask somebody else if they have the 2020 version and rent that. So you can easily change your asset if it is a short-term lease. So that is the first advantage. The next advantage is when it's a long-term lease, you can't, like quickly cancel the lease or anything, right? If you cancel it, you will have to pay a penalty. Whereas short term, after some time, you can easily cancel it and go for another lease. So that also can be considered an advantage. Third point is something that Rushdie mentioned about maintenance. Now, usually when you go for a short-term lease, depends on the asset also. Okay, depends on the asset also. In Sri Lanka, it doesn't happen. But usually, if you go for a short-term lease, the owner, he will give you the maintenance. Meaning, now, for example, if I have 100 cars and I'm renting it, I will have skilled technicians who can actually do the maintenance of the cars on a regular basis. So the person who rents from me, he can get access to skilled maintenance easily if it's a short-term lease. So that is definitely an advantage for a company. Okay, that's definitely an advantage. Now, cars is something everybody uses, right? Think of it like now, for example, if it is some special machine, like for example, you're a printing press or something, you have a special machine that you only use by press people. So for that, getting skilled maintenance is not easy. Unlike a car where everybody can do maintenance, right? So in that situation, a short-term lease is always an advantage. So then you can talk about long-term lease, right? So the first advantage is you get to pay in installments. Okay, so instead of paying the amount outright, 750,000 in one go, you get to pay in, installments every year. So that will give you a cash flow benefit. Okay, so that's the first thing. Anything else about a long-term lease? I can't really think of. Let me see what these people are saying. Okay, so they also can't, the examiner also is only talking about the fact that long-term lease, you can pay in installments. Other than that, he's just saying short-term lease, long-term lease, they both provide access to non-current assets in cases where borrowing may be difficult or even not possible for a company. So in case I can't borrow, I can't take a loan easily, then a lease will help me out. That's what they're trying to say. Okay, so that will give you 5 easy marks, right? C part, in Islamic finance, explain briefly the concept of riba, interest, and how returns are made by Islamic financial instruments, right? Very common question for 5 marks for theory, because sometimes when they want to test theory, they won't have anything relating to that question. In that case, they will simply put Islamic finance question for 5 marks, even 8 marks sometimes. You will have to explain it. So let me go to the marking scheme. It will be easier for us to get these 5 marks. Page 439. So C part, right? So first they're asking you what is interest or riba, right? So it's saying here interest or riba is a predetermined amount received by the provider of finance over and above the principal amount of finance provided. Main point is riba is forbidden in Islamic finance. So what is riba? What is interest? If somebody lends somebody a particular amount, when the person pays back the principal, the amount that he lent, he will end up paying a little more than what he got. So the little more that he pays, that is interest. So the entire syllabus, FM, it is based on interest. Okay, so the moment we talk about Islamic finance, everything that we talk about in this entire chapter, in this entire paper for that matter, it becomes irrelevant. Okay, so if you are going to be interested in Islamic finance, for example, if you have to work with somebody in the Middle East or something like that, then you have to learn about the Islamic financial instruments separately. Okay, so the first part of the question just asked you to explain about interest. The second part is saying, how will Islamic instruments earn a return? Because end of the day, if we are going to use Islamic finance, we have to find a way to earn profit. No? We have to find a way to earn a profit. So there are different Islamic instruments that you can explain about. So that's what it's saying here. Islamic financial instruments require that an active role be played by the provider of funds so that the risk and rewards of ownership are shared. Now, this is very important, right? If you take normal traditional finance, when you take money from the bank will not get involved with your business. They will give you the money, they will ask for interest, and that's it. If you even take shares, like even if you issue shares and collect money through your shareholders, then also they will come for a AGM, they will vote, but they won't really be involved in the business much. But when it comes to Islamic finance, if somebody gives you finance, he has the right to get involved in the business. He has a right to have an active role in the business, right? So that is the main distinguishing factor between normal financial instruments and Islamic financial instruments. Now, just saying these 2 points will only give you 2 marks, right? So after this, you have to explain about maybe 2 or 3 specific Islamic financial instruments, okay? So you can read through this, but I'll just give you the slide so it's easier for me also to explain it a bit faster. Yeah. See, yeah. Okay, so I'll just go through Islamic finance quickly because like I said, it is something that they can have a lot of theory. I mean, they can ask you about 5 marks from this area, right? So there are basic principles that you have to understand. First thing is no interest. Next thing is whatever profit or loss you make, it has to be shared by everybody equally. Okay, because again, traditional finance, if a company goes bankrupt, that's not going to affect the bank who gave him money. He will just sell one of the assets and recover his, the debt that he gave and call it a day. But whereas when it comes to Islamic finance, everybody has to share profits and losses. Third thing is you can only finance whatever you're doing, whatever business you're doing, it has to be Islamically accepted transaction. So no investment in alcohol, gambling, anything that is not Islamically accepted, you can't invest in. Those are the 3 main points. Now, there are specific instruments that we have to know about. The first one is what we call murabaha or trade credit. Okay. So, to explain this easily, what we are talking about is, let's say, for example, I want to buy a car. Okay. I want to buy a car. Okay. So, I want to buy a car. So, Aziza is here. The car is here. I don't have the money to buy the car. Okay. So normally what will I do in normal finance? I will go to the bank and let's say this car is about 5 million. I'll go to the bank and I will say, there is this car I want to buy. Give me a loan. So what will the bank do? They will say, fine. They will give me the loan of 5 million. I will have to pay them an installment every month or every year, whatever we work with, most of the time, every month. Okay. And then with this 5 million, I will go to the car dealership. I will buy the car. I will use it. That's what will happen usually. Now, the issue with this system is when I pay back the bank, he won't let me just pay 5 million. I have to pay 5 million plus some bit of interest. Right? I have to pay some bit of interest. So obviously this is not allowed. So when it comes to murabaha, what we do rather, is now let's say again I want to buy this car, it's 5 million. I go to the bank, they buy the car. Bank buys the car. And what do? They sell the car to me for maybe 5.5 million. Because in Islamic finance, interest is not allowed. Correct. But selling at a profit is allowed. We can do business now. So what we do, we make the bank buy the car on behalf of us and they sell it to us at a profit at 5.5 million, for example. And then they tell me, this 5.5 million, you can pay in installments. So every month you can pay some amount. At the end of maybe 5 years, you will end up paying the entire 5.5 million. Okay. So this is how murabaha works. So one thing here is you must understand there will be no penalties. Now, for example, the bank tells me I have to pay back in 5 years. For some reason, I take 6 years. Okay. That they can't really charge me a penalty. They can't charge me a penalty if I end up taking a little more time, first thing. And even if I pay back the entire 5.5 million in 3 years, usually we don't welcome that also. And the bank doesn't have to give me a discount just because I paid back early. But if he wants, he can give me a discount. That's up to him. Okay. So those are the principles of this murabaha or trade credit. All right. So it's like a bank loan. That's why we call it trade credit. Okay. The second one is ijara or a lease. That is similar to normal short-term lease. What happens? The bank, they own the asset. They give it to us for some time. We can use it. We have to pay them a rent. They will be responsible for major maintenance. We will be responsible to make sure that the asset is in running condition. That's it. Then we have sukuk or debt finance. Now, debt finance is very different to normal debt finance. Okay, reason is the normal debt finance is the biggest problem when it comes to Islamic finance. So, suppose somebody gives you a debt. Okay, they become an owner of that particular business. Okay, now if somebody invests you, gives you some money, they also can participate in the ownership. Okay, and they also can have a portion of profits. Now, usually a bank can't have a portion of profit ever. They will only take interest. That's it. Profits and all, we don't go to share with the bank. But if it is a sukuk, then the bank, they can claim a little bit of the profit. And if that business that they gave money to, if they make a loss, then a portion of the loss also they have to bear. So sukuk, although we say it's debt finance, it's very different to the normal debt finance. Okay. Then we have mudaraba or equity finance, right? How this works is like this. You have two people. Let's say A and, sorry. Okay, so we have A and B. So one person, he gives the money for the business. The other person, he gives his expertise. So the person who gives the money, we call him the Rabbul Mal, because the person who has money. And the person who is giving his expertise, or he's the one who is working in the business, he is called the Mudarib. Okay. So the person who gives money, he doesn't have to necessarily be, actively involved in the business. But any profits, we will have to share with him according to a pre-agreed ratio. So maybe we will agree that 60% of the profit should go to the Rabul Mal, 40% has to go to the Mudarib. We will, agree that beforehand itself, and that we will follow for profits. But if you make a loss under a Mudaraba contract, then the entire loss has to be taken up by the Rabul Mal, because he is the one who has the money. Okay, so entire loss has to be taken up by him. That's how Mudaraba works. Musharaka, it's venture capital. Okay, here it's similar to Mudaraba. The profits is shared in a pre-agreed ratio, let's say 60-40. But if there is a loss, now this is a situation where we might have two people, A and B. The difference between Mudaraba and Musharaka is both of them put in some money into the business. In Mudaraba, only one person puts. So here what happens, pre-agreed ratio for profits, but losses will be shared in the ratio of their investment. Okay, so if A invested 50%, B invested 50%, losses will be shared in proportion to their contribution only. And that's venture capital or musharaka. Then we have hiba, gift. It's a situation where if you have a savings account in an Islamic bank, what happens? They end up investing that amount that you put in the bank, they invest it in some business that will give them profits, right? So they will share a portion of that profit with you every month, and it's called a hiba, a gift, meaning something that they are giving out of their goodwill. Okay. The last one is called Kardal Hasan, or a good loan. This is where somebody gives, the bank, for example, will give you a loan, say 5 million loan, and they will tell you, you keep this for 5 years, repay me. But when you repay, just pay 5 million, that's enough. Okay, so I gave you 5 million, you pay the same 5 million, that's fine. Now, if the person who takes the money wants to pay a little more, they can, but it's not compulsory. Okay, because again, if it is compulsory, then it becomes interest. Okay, so these are the 7 types of financial instruments under Islamic finance. For these 5 marks, if you can explain about 2 to 3 of this, that will give you your marks easily. So easy marks. Okay, right. So make it a point to go through it and learn it. Because if this comes for theory, that's a good thing because you don't have to think anything. It's just going to be, like writing what you know, just writing whatever you learn. Okay. Right. So it's 9:03 now. Hope you had a good TRG. I'll see you guys next Monday. That's the 13th. So 13th, what I have planned for you is a few MCQs and MPQs. But most probably we will have more time for a little more of this section C as well. Okay. Right. So have a great week. Learn. Don't waste your time this week. Make sure that you are at a much better position when we come for the TRG next week. Okay. Right. No problem, Asjad and Rushdi. I'll see you guys on Monday. Right. Have a good night.